Hello, I'm Darryl Gobbett. Over the last just couple of days we've been looking at the impact of falling interest rates on term deposits and what that might actually mean for investors as term deposit interest rates come down. I suppose our view is that we're going to see further falls in term deposit rates, and one of the charts we used last time, which I'll again show today, indicates how the relationship between term deposit rates and the bank's cost of funds, as shown by the swap rates, and also the government bond rate of 3 years, has changed considerably, particularly since the global financial crisis and the Lehman Brothers collapsed in late 2008. Another chart which we put together, which I think indicates where term deposit rates could well be headed in the next couple of months, is one now showing which is the relationship between the dark black line, which shows inflation in Australia, the black barred line, which shows 90-day bank bill rates at the end of each month, and then we show the term deposit rates for 3 months, 3 years and 1 year, how they relate to each of those. And one of the things you'll notice is that really up until the Lehman Brothers collapse in 2008, when you see that very significant fall in bill rates, is that term deposit rates tend to be below the bill rate, but are still giving a real rate of return. In other words, they're above inflation. What we saw in the aftermath of 2008, as the banks really struggled to lift their retail deposits, was that significant upward shift in term deposit rates, so that for the last 3 to 4 years they've been well above the bank bill rate and quite significant also in real terms. Now, as we've been said in the previous presentations, we believe the banks are no longer going to be struggling as hard to get deposits as they have in the last couple of years, and so therefore that premium of term deposits over bank bill rates is likely to sort of shrink. Now, if the bank bill rate heads towards under 3%, say 2.75% with a further cut of the cash rate, we think the banks are going to be pushing down those short-term term deposit rates even further. So we could be back in what is the more historically normal situation, where the term deposit rate, particularly say for 3 months out to 12 months, will be below the bank bill rate. And I think investors need to be aware of this, because it could well be through the next 12 months we see term deposit rates, particularly say for the 3 and 6 months, well under 4%, perhaps even approaching 3%. And that's going to mean having to look for other investments for income in a low interest rate environment.